Today we're going to talk about account options to save for a child or grandchild, including the new Trump accounts. What are they? What are the advantages, disadvantages, and how do they stack up to other savings accounts for minors, such as a minor custodial account or a 529 savings plan? This should be helpful information to know if you have a child or a grandchild and you're helping save for their future. First, I must note that these accounts are brand new, just enacted by the One Big Beautiful Bill Act, or H.R. 1, that was signed into law on July 4th of this year. The following information is based on publicly available legislative language and may evolve with future IRS or Treasury Department guidance. First, this account comes with an initial $1,000 seed deposit from the U.S. government. If you have a child or a grandchild born between January 1st, 2025 and December 31st, 2028, as long as at least one parent reports that child's social security number on their tax return, the child will automatically have an account open on their behalf and $1,000 will be deposited into their account. The investment options for these accounts are low-cost index funds. So think an S&P 500 index fund with an expense ratio below 0.1%. If you are not born in this time period, you can still open up an account. You just won't get that initial $1,000 seed deposit. Let's look at a hypothetical return on that $1,000 deposited by the time the child reaches 60 years old. Let's say an S&P 500 fund has a modest average annual return of 7% over the 60-year time period. By the time that child reaches 60 years old, that account is going to be worth nearly $58,000. Now, you're not going to retire on $58,000, but it's certainly not going to hurt. Now, whether or not you as the parent or grandparent should contribute more funds into this account, it's going to be worth looking at your other options first. These numbers will be adjusted with inflation, but parents, relatives, friends can contribute up to $5,000 annually to the Trump accounts. Employees may contribute up to $2,500 of that $5,000 limit on behalf of the parent. The taxation of these accounts are essentially the same as a traditional IRA account, with a few minor differences. The funds cannot be disbursed prior to the child turning 18. Earnings distributed pre-59 and a half that are not considered qualifying distributions will be taxed at ordinary income rates and hit with a 10% early withdrawal penalty. There are qualified distributions for higher education expenses, first-time homebuyers, natural disasters, etc. These qualifying withdrawals will avoid the 10% penalty and be taxed at the more favorable long-term capital gains rate. It'll likely make more sense to contribute to a 529 or a custodial account depending on your goals. The 529 contributions may give you, as the contributor, a state tax deduction depending on your state, and the entirety of the account can be withdrawn tax and penalty free for educational expenses. That includes K through 12 and higher education. So if you're saving for a child's education, the 529 is going to be a better option for you than adding funds to the Trump account. A custodial account, or put more simply, a regular investment brokerage account for a minor, referred to as UTMAs or UGMAs, might give you better tax treatment over the life of the account than the Trump account, and will provide more flexibility on how the funds can be used. You can increase the basis in these accounts through a tax gain harvesting strategy, and earnings from appreciated assets will be taxed at the more favorable long-term capital gains rate, regardless of whether it's a qualifying distribution. This gives more flexibility to use the funds prior to age 59 and a half for reasons that fall outside of a qualifying withdrawal. A potential positive for the Trump accounts is some companies might contribute to accounts on their employer's behalf when they maybe weren't planning on doing so prior to the creation of these accounts. This might be an avenue to accept additional free contributions on top of the initial $1,000 contribution. Charities could potentially contribute to these accounts uniformly to a group of children based on some demographic like geography, birth year, etc. So again, some more potentially free contributions to these accounts. In summary, I would say these accounts are going to be a part of a child's saving strategy, and I think they could play a pivotal role in teaching children about saving for the long term. Even that initial $1,000 deposit 20 years later is something that can show a 20-year-old the power of compounding interest, especially if they don't have a caregiver contributing to any of the other account types on their behalf. The benefit of punishing withdrawals pre 59 and a half might force people who would otherwise have used the funds early in life to essentially leave that initial seed deposit to grow out of sight, out of mind for 60, 65 years and be a nice addition to their overall retirement savings. I would look at these accounts as a potential piece to the overall puzzle, and it makes sense to be happy about any free deposits you receive into these accounts. I would encourage you to consult with a financial professional who understands your specific savings goals and will stay up to date on your options as they evolve. Please click here for an additional video on how the One Big Beautiful Bill completely overhauls the federal student loan repayment program. And hit the subscribe button so you do not miss next week's video. We're going to talk about 3 questions you should ask when you're interviewing a financial advisor. And as always, money is a tool, knowledge is freedom, and planning is power. I hope you have a great rest of your day.